broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, my name is Laurel Witt and I'm the staff attorney here for the Colorado Municipal League. I'd like to thank you for attending today's webinar covering amendments to SEC Rule 15c2-12. Colorado attorneys and judges who attend the entire webinar may claim one general CLE credit. Because this webinar will be recorded and posted on our website, we will not share the course ID information during the presentation. We will instead email the course ID to attendees following the webinar. Elected officials attending today will receive one university training credit. The PowerPoint presentation and the webinar recording will be posted on our website at www.cml.org within 48 hours. For those of you who aren't familiar with the webinar format, you see a control panel to the top right of the screen. You have an orange arrow to the left of the panel which minimizes the entire box. All participants who will be muted for the webinar, but are encouraged to ask questions by typing them into the question box on the control panel. We will hold a Q&A near the end of the webinar, but please feel free to type the questions as you think of them throughout the presentation. Our presenter today is Dee Weiser, a partner at Butler Snow. Dee Weiser graduated from Dickinson College in 1973 and from the University of Denver School of Law in 1976. He has worked for local and state governments for his entire career. He is a partner at the law firm of Butler Snow. Weiser started his career as staff attorney to the Colorado Municipal League. His practice primarily involves municipal bond approvals and disclosure work for a variety of Colorado and Nevada issuers. Weiser was named 2005 Best of the Bar for work in public finance by the Denver Business Journal. He has also been listed in the Best Lawyers in America since 2007 and has been selected as the Best Lawyers 2012 Public Finance Lawyer of the Year for Denver. Also with us today in the room is David Broadwell, the General Counsel for the Colorado Municipal League. At this time, we will turn it over to Dee.
Thank you, Laurel. And I'm glad David is with us today. I'm sure he'll hold me to account. So today's program is about continuing disclosure obligations that government bond issuers have pursuant to the Securities and Exchange Commission Rule 15c2-12 in connection with public bond offerings. Starting in about 2008, a number of state and local governments began privately placing their bonds and other obligations directly with banks and other financial institutions. As a result of that phenomena, the SEC became concerned that investors in publicly offered debt don't have the adequate information or timely information about those privately placed obligations. So to put a little finer point on that, an example would be, say, a city had issued bonds in February of 2017 payable from water and sewer revenues, and then in January of 2018 entered into a loan agreement with the Water and Power Authority payable from the same revenue stream. That loan agreement would not end up being disclosed in any document that's available to the bond market until the 2018 audit is completed, which would be sometime in 2019. It might be as late as summer of 2019. So you can see that there might be an 18-month lag from the time the loan agreement is entered into and it is publicly disclosed. And that's what the SEC and investors are concerned about. So in 2018, the Securities and Exchange Commission proposed amendments to the continuing disclosure provisions of the rule to address that concern. And those amendments took effect February 27th of this year. So to briefly review what the rule requires, I should maybe say that the SEC has no direct regulatory role over state and local government bond issuers, other than by way of enforcement actions for anti-fraud types of violations in connection with a municipal bond offering. So the SEC, in order to get more continuing disclosure from state and local governments, instead adopted a Rule 15c2-12, which prohibits bond underwriters from purchasing or selling most municipal securities unless they've gotten the bond issuer to enter into an agreement to provide certain information to the market on an ongoing basis. That agreement is often referred to as an undertaking. Prior to 1994, when the rule was adopted, there was no obligation on the part of a state or local government bond issuer to provide any information to the marketplace after the initial bond offering. Contrast that to corporations, which have such obligations and have had those obligations for many years, where not only do they have to file and get approval for their initial prospectus, but they make quarterly and oftentimes more frequent filings that are available from the SEC's website. The information that state and local government bond issuers have to provide include annual financial information and operating data. And so that might be, in the case of a general obligation bond, it might be the most recent certified assessed value, the most recent certified mill levy, and the collection percentage. In other words, is the issuer collecting 99% of the taxes certified, or is it something less than that? The second piece of information that has to be filed are annual audited financial statements. And finally, there has to be timely notice of the occurrence of certain events, and those notices are known as event notices. Prior to the most recent amendments, the rule specified 14 events for which those notices are required to be filed. It would be things like draws on a reserve fund, or a rating change, bankruptcy in the worst case, other kinds of defaults. And those notices have to be filed 10 business days after the occurrence of the event. And so in and of itself, those original 14 events have caused problems for issuers to make sure they have those events at front of mind and can in fact comply with the 10 business day rule. These new amendments add 2 additional events to the rule, and all of this financial information is now filed on a website run by the Municipal Securities Rulemaking Board. It's known as the Electronic Municipal Market Access System, and for short, it's called EMMA. And you'll see on the screen there the website. But if you're looking for information about your securities or the securities of other issuers, that's a place you can go to get a lot of information. So the new event 15 requires a notice to be filed if there's a new financial obligation incurred, if it's material, or if there are agreements which are really amendments to prior agreements related to covenants or events of default or remedies or other terms like that regarding a financial obligation. And again, it has to be material, and we'll talk later about materiality. Rule 16, or Event 16, as added to the rule, also requires notice of a default, any event of acceleration, any termination right, or other modification of terms related to a financial obligation if this reflects financial difficulties of the issuer. So notice 2 different standards. For Event 15, it's materiality. For Event 16, it has to reflect financial difficulties to be required to be filed. The amendments define a financial obligation to mean 1, a debt obligation, 2, a derivative instrument, and we'll talk a little bit about what that means, and 3, a guarantee of one of those obligations. The term financial obligation does not include any municipal securities for which an official statement, which is the municipal equivalent of a corporate prospectus, has been filed on the MSRB website consistent with the requirements of the rule. Unfortunately, the rule doesn't define any of the terms that are used in the definition of financial obligation. And the way the SEC proposes rules, there is an adopting release that they approve, and that adopting release reviews the history of why the rule is necessary, reviews comments received by parties after the rule was proposed, and provides a bit of legislative history, if you will, around the rule. And so in this case, it's it's important probably to look at the adopting release to better understand what is a financial obligation, but it is really a debt obligation, in other words, one that is a vehicle to borrow money, and it expressly excludes ordinary financial and operating liabilities that a government might incur in the normal course of their business. But this will be a line drawing that finance directors and municipal attorneys will have to deal with. In particular, one of the issues will come up in the context of leases and what leases are subject to the requirements of the rule and what are not. And for the finance directors listening in, you know that GASB has proposed changes to their rules that does away basically with the traditional notions of a capital lease versus an operating lease. And so this rule does not use those terms either, but that's probably does rough justice to what leases would in fact be subject to the rules. And so, for example, if your city enters into a lease for a copier or some other equipment, that most likely is not a debt obligation, regardless of its size or duration, or even if it has an option to purchase at the end of the lease term. But lease arrangements that operate as a vehicle to borrow money are likely debt obligations, and of course in Colorado, given the restraints of Tabor, we see more and more governments using lease purchase type financial obligations as a way to borrow money, since voter approval is not required. And so it might be a straight lease purchase agreement directly with a third party or private party, or it might be a certificate of participation transaction where in fact investment instruments or securities called certificates of participation are actually sold into the public marketplace. But again, the SEC seemed unwilling to provide any further enlightenment on this, but at some webinars and other public appearances, the SEC staff has used an example in this area to try and distinguish the kinds of leases for which a filing would be required. And their example is, if your community goes to the local car dealership and rents a fleet of police vehicles directly from the car dealer, that's an operating lease that's done in the normal course of your business activities and would not require a filing under the rule. On the other hand, if you go to a leasing company or a bank and enter into a lease purchase transaction where they effectively are lending the money and they go out and acquire the vehicles for you, then that would be the kind of lease that would require disclosure. Probably what the SEC staff guidance or public statements about this doesn't recognize that it's probably pretty rare that the car dealer directly enters into a lease with you. More likely it is some finance entity owned by General Motors or Ford, and it is that entity that is entering into the lease. So I think that again will be one of the line drawing areas that people will have to confront as they deal with these changes. The rule also does not define what a derivative instrument is, but I think we can know that it has to, one, be related to some bond issue or security that's outstanding or that it's about to be issued. And so it's probably things like an interest rate swap where, and a lot of Colorado governments don't enter into these transactions, but for those who do, an interest rate swap would be one where maybe government issues variable rate bonds to the marketplace, so the interest rate changes periodically, maybe weekly or monthly, but then simultaneously enters into an interest rate swap with a third party to effectively fix the rate. And there are some financial reasons why that can be beneficial as opposed to just issuing a fixed rate bond directly. But it is those kinds of derivative contracts that are subject to the terms of the rule. So as I indicated, materiality is a bit of an elusive concept in the securities world. And I'm on the board of directors of the National Association of Bond Lawyers, and we have on more than one occasion asked the SEC to provide some bright line definitions of materiality, and the SEC consistently refuses to do that. The courts have given us the only definition we really have, and that is something is material if there's a substantial likelihood that a reasonable investor would consider the information that's subject to the materiality question in deciding whether to buy or sell a security. So it's kind of an easy rule to state, but much more difficult to apply. And so I think more likely than not, at the end of the day, I suspect governments will tend to over-disclose things rather than get into the conversation about what's material or not. So if an issuer issues new securities that are otherwise subject to the rule on or after February 27th, the amendments apply. And that means the undertaking that the issuer has to enter into with the underwriter in connection with those bonds has to include the two events 15 and 16, have to be set forth in the undertaking. That now means there's a contractual obligation for the issuer to comply. So the issuer will be required to disclose any financial obligations that are specified in Event 15 that are entered into after the securities are issued, if those financial obligations are material to the investors in the outstanding bonds. The issuer also has to provide notice of the occurrence of any of the items in Event 16, and recall these are largely events of default, termination events, or amendments that are necessary as a result of a financial difficulty of the issuer, regardless of when the financial obligation was entered into. So the amendments only apply if an issuer has entered into an undertaking on or after February 27th of this year. And they don't apply retroactively to undertakings entered into before February 27th. So if your community had entered into undertakings with respect to bonds issued in 2013 and 2017, the amendments do not apply to those bonds. I should pause here and say that both the SEC and the Municipal Securities Rulemaking Board, as well as other market participants like credit analysts, have encouraged municipal issuers to voluntarily file when they do a bank loan, so that large gap that I mentioned at the outset between when the loan was entered into and when the audit comes out would not be an impediment to the marketplace getting additional information. So I apologize, I don't like to have PowerPoints have quite so many words on the page, but in this webinar context, this is probably the best way to go through this example, which I think will put a little bit of more meat on the bones in terms of how the rule works. So if an issuer entered into a bank loan in 2016, and then let's assume on April 1, 2019, the issuer closes a $15 million fixed rate bond offering that was publicly sold, and the issuer entered into an undertaking with respect to those bonds. So that undertaking, pursuant to the requirements of the rule, has to include events 15 and 16, thus creating the contractual obligation for the issuer to provide event notices. And then let's say in October of 2019, the issuer enters into another privately placed bank loan for which no undertaking is required. So then in June of 2019, the issuer forgets to file an insurance certificate with the bank that makes the 2016 loan. So more likely than not, there might have been a covenant that every so often, perhaps annually, the issuer would provide evidence of the issuer having in place insurance policies. So the failure to do that results in a covenant default under the loan agreement. And then in December of 2019, the issuer's largest taxpayer closes, and the issuer notifies the banks holding the 2016 loan and the 2019 loan that it won't be able to make debt service payments in the next several years. And so the issuer and the banks negotiate an extension of the loan terms and a reduction in the annual payments. So how does the rule work here? After executing the April 2019 undertaking, Event 15 does require the issuer in this example to disclose any new material financial obligations on EMMA, but not to disclose any prior financial obligations. So the issuer is not required to make any disclosure directly related to the 2016 bank loan, although again, the SEC and others would encourage a voluntary disclosure of that. However, the issuer is now contractually obligated to make a disclosure about the October 2019 bank loan if it is material. And so let's talk about materiality in this context a moment. So let's say that the bonds that were issued in our example were sales tax revenue bonds, payable from a pledge of all or some portion of the municipality's sales tax revenues. And let's say that the new bank loan that was entered into in October of 2019, well, let's even make it better. It's not a bank loan. It's a loan agreement with the Colorado Water Resources and Power Development Authority or with the Colorado Water Conservation Board, payable exclusively from water revenues. I would say under those facts that the new October 2019 bank loan is not material to the holders of the outstanding sales tax revenue bonds because they are different revenue streams. Now, someone might argue that even though the revenue streams are unrelated, that if an issuer becomes over-leveraged and enters into too many financial obligations, that could lead to greater financial difficulties and maybe in the worst case, a bankruptcy. But I think that's too tenuous to require a filing under the fact pattern I just went through. Event 16 does not require the issuer to disclose the covenant default. Remember, the covenant default here was the failure to file an insurance certificate, because that was just somebody's oversight and doesn't reflect any financial difficulties. However, the issuer most likely has to disclose the amendments that were made to both loan agreements as a result of the closing of the largest taxpayer, because those modification of terms do in fact reflect financial difficulties. So again, to understand, the SEC doesn't directly regulate issuers, but it does directly regulate investment bankers who act as underwriters. And so these rules are effectively imposing new duties upon underwriters. So if your community's in the process of doing a new bond issue now, and we're working for several who are, underwriters are going to not only review the form of the undertaking that's being executed in connection with the new bond issue to make sure that it has events 15 and 16 in it, but they're also going to probably inquire about the issuer's existing financial obligations and the material terms of those financial obligations, even if they're not required to be reported at this time under Event 15. The underwriters are also likely to inquire whether the issuer has in place policies or procedures to assure compliance with the amendments. And if not, then the underwriter is probably going to ask the issuer to describe the steps it intends to take, even informally, to ensure its compliance with these undertakings. And I think one of the observations I have in these early days is the question of who in the organization is the point person who's going to know that any of this is going on. I have some municipal clients who are pretty decentralized, and lots of different department heads have contracting authority. And so it will be more difficult to comply with the rule in those kinds of organizations as opposed to one that's highly centralized where there is a point person. For the attorneys on the call, I fear that you may be the point person at the end of the day, because I suspect in most jurisdictions, contracts have to go past the municipal attorney, at least for a review. And so it will be on your shoulders, I fear, to make sure to identify whether some of these are occurring. It will be more challenging, I suspect, for things like event of default notices. And again, as we're drafting documents, we probably should be more thoughtful about, under the terms of the documents, who gets the notice. Does the notice just go to the finance director, or does it go to the finance director and the city attorney? How many people get notices under the documents, again, to help assure compliance? And again, what the rule requires here is that if any of these events occur, the filing has to occur within 10 business days after the local government receives the has notice of the event. And so again, this will be where figuring out your internal policies for compliance will be, in fact, a challenge. Some resources that I think are useful: the Government Finance Officers Association, which in fact has its annual conference in Los Angeles this week, and I'm sure is talking about this issue with its members, has put out some guidance. One, they advise that issuers should review their debt management and disclosure policies and consider adding any new provisions that these amendments might require. They suggest creating a master list, not only of your current financial obligations, but have it ready to be updated for future ones. But again, this will include loan agreements, capital leases, any derivatives, any guarantees. Again, developing a system to track when financial difficulties are occurring with respect to these obligations. And working with counsel, whether it's the municipal attorney or your outside bond and disclosure counsel, to determine whether the materiality standard or financial difficulty standard has been met. So my advice to folks who are listening in would be, if you enter into a new financial obligation, or you amend an existing financial obligation, or receive a notice, make sure to alert the municipal attorney and then contact your outside counsel to have the conversation about materiality, because I think not all things will be material. But having in place a process to monitor all this, I think, is the important part. The GFOA guidance is available at this website that's on the screen before you. The Municipal Securities Rulemaking Board has also some resources that are available for issuers regarding these amendments, and those websites are available there for you. And my firm has put out a guide on this, and we put up our website, and I'm sure other law firms have done the same. So maybe in closing, I should say that the people who have the least to worry about here is if you've not publicly issued any new bonds since February 27th of this year. If you haven't done that, or until you do, these new rules don't apply, nothing to worry about. But if you do issue new bonds on or after February 27th, then understand that the undertaking has to include both events 15 and 16. And once that undertaking is in place, then the issuer has to be in a position to monitor and report on new financial obligations or amendments to new or existing financial obligations after the execution of the undertaking, and to monitor and report defaults or other amendments which might reflect financial problems. And again, materiality is the operative issue here. So with that, Laura, we can take any questions.
Sounds good. Thank you, Dee. I encourage listeners to type in questions into the question box on the control panel. And while we're waiting for anybody to ask questions, I have a question for you, Dee. What are some of the consequences if a municipality doesn't comply with these rules?
Good question, Laurel. First and foremost is that, again, when you're doing a new bond offering, the underwriter is going to do diligence around trying to learn whether the issuer has in place policies and procedures to comply with the new amendments. In fact, more fundamentally, do they understand the obligations of the new amendments? And And in the worst case, the underwriter might say, sorry, we can't underwrite your bonds because we're not satisfied that you understand your obligations under the rule. That would be, I think, the worst case from the underwriter's perspective in their relationship with the issuer. The real worst case for the issuer is if the issuer enters into one of these undertakings to comply with rule events 15 and 16, does a later publicly offered bond offering, and in the offering document says something like, the issuer has never failed to comply with prior obligations. And then if it turns out that in fact they did fail to comply, that's where there's a possibility of an SEC enforcement action. And for people who've been around a while, you'll remember that a few years ago, the SEC embarked on what was called the MCDC, which was an acronym for Municipal Continuing Disclosure Cooperation, sort of a funny way to phrase an enforcement effort. But in that process, the SEC said, we think a lot of you are not complying with your obligations, and you've made material misstatements about your compliance in public offered bond documents, and we're going to give you a certain amount of time to report yourself. And then if you report yourself, we're going to require you to take some action. So I think that is the real worst case for a bond issuer under these rules.
Great, thank you, Dee. It looks like we have a couple of questions from the audience, and again, I encourage anyone to type in questions that they have. This question says, is it safer just to disclose all financial obligations in accordance with the SEC guidelines to be sure we are in compliance?
That's a great question, and I do think it is a likely result. Last week I was in Washington with my National Association of Bond Lawyers hat on, and we met with the Municipal Securities Rulemaking Board, and they said already here we are just 4 or 5 months since the rule went into effect, and they've already had 167 filings from issuers around the country. And as I was talking to my colleagues from around the country, I think the general sense is better to over-disclose than under-disclose if you have any doubts. Another question here will be, the rule doesn't specify how the disclosure occurs, and there are a couple different ways to do it. One might be just a summary. For example, if you're about to enter into a new loan agreement, maybe it is filing the term sheet that the bank has provided you on the EMA website. Another approach would be to actually file the full loan agreement, probably with some redactions. There are probably some things like bank accounts you don't want out there for the whole world to see. And investors in the marketplace probably want both. They probably want a little summary, and then they want the full loan agreement so they can decide if they want to look at the full loan agreement, they can do so. I'm of the camp that I think filing the full document is the safer place to be, because then you don't get into an argument that you failed to disclose some material term. But it's early days yet, but I think that that's a likely outcome.
Great, thank you, Dee. The next question says, do these new amendments apply to the municipality guaranteeing a bond for a not-for-profit entity?
Yeah, if a municipality is in fact guaranteeing an obligation for another entity, whether it's a not-for-profit or maybe another government, then the rules apply. In Colorado, at least in the school district statute, the state treasurer effectively guarantees the payment of all school district general obligation bonds and reimburses the treasury through holding back future state aid payments. But from the state's perspective, that's a guarantee of a bond of the school district, and so that would require disclosure by the state.
Great, thank you, Dee. The next question here, I think, is more of an example question. It says, a municipality issues COPs for rent payments under a sale, which equals a leaseback, of capital assets, such as buildings. A lawsuit files arguing deal is debt in violation of TABOR. Is mere filing a noticeable event?
Well, for one, whoever filed the lawsuit hasn't read all of the appellate cases we have saying it's not a problem, but that for sure happens. We understand that. And no, that would not be a circumstance that in and of itself requires a filing. Now, if there was something in the lease documents that said the filing of a lawsuit itself leads to an event of default, then that might be an event 16 kind of filing, but you would have to consult the document specifically to know. But the mere filing of a lawsuit would not require a notice.
Great. The next question says, would a city's, quote, moral obligation guarantee of a URA borrowing be a reportable debt obligation?
Yeah, so I think to maybe provide a little background for everybody on what that's like is oftentimes in Colorado, an urban renewal authority might issue bonds to the marketplace or enter into a loan agreement with a bank or some other maybe a metropolitan district, for example. And it is often the case that the city, who is effectively the parent of the urban renewal authority, makes a moral obligation commitment. But in order to avoid that being something that has to go to an election under Tabor or under charter provisions, that moral obligation is expressed as an annual appropriation obligation. And effectively what the documents would say is that the city manager is directed to bring forth to the council an appropriation if there's ever not enough TIF revenue to pay the obligation, but it's wholly up to the city council whether to appropriate. So that's a long way of providing background to this question, but I do think that that would be the kind of guarantee that the SEC had in mind being disclosed under Event 15.
Great. It looks like we don't have any more questions. So Dee or David, do you have any more closing thoughts before we close out our webinar?
This is David. I'll make a comment. Whenever I listen to sessions like this, Dee said a few minutes ago, inevitably the obligation may fall to the attorney or the responsibility may fall to the attorney. That's my least favorite part of these presentations. And you know, we always say we represent clients who it's their job to do it. We give them advice, they do it. But tease it out a little bit more, Dee, in terms of, are you saying that the actual posting to this internet repository is done by done in your experience by the attorneys themselves, or no, the attorney just kind of monitors the work of the city, but then directs who to make the postings to the internet repository of notices?
Good question, David. No, the attorney is not the filer in my experience. I've never done a filing, although I'm sure there are people in my office who have. I think it's really for the attorney to act as the one whose antenna goes up when they see a new contract coming across the desk or a letter from a vendor saying, gee, there's this problem under an existing contract. That's the moment the attorney might call the finance director or might call the community's bond and disclosure council to say, we just got this, what do we do with it? It's really acting as that kind of gatekeeper role, I think.
Thanks for that clarification.
Yeah. And I would say anybody who has further questions about this, feel free to contact me. I think my contact information is on the website. You can also find me on the internet pretty easily.
Mm-hmm. Well, I'd like to thank you, Dee, for sharing this information with us today. And I'd like to thank you, our listeners, for attending. Once again, you'll receive the course ID for the CLE credit by email this afternoon. And you can find the PowerPoint and the recording of this training on our website by the end of the week. Thank you all for joining us today. This concludes the webinar. Have a nice afternoon.